Welcome back to the Neuro Finance Masterclass. I'm Ibrahim, joined as always by my amazing co-host, and we are beyond excited to have you with us for day 96 of our 365 Days to Financial Freedom series. Today's theme is Volume Profile, seeing the third dimension of price.
Absolutely, Ibrahim.
Today's explainer is a literal game changer. We're stepping inside the fair value fortress to master the volume profile, finally giving you that third-dimensional view of the market. Exactly. We're taking your charts from a flat, two-dimensional guessing game and turning them into a vibrant 3D tactical map. Get ready to see the market like a true architect.
Here's the blueprint for today's masterclass. First, we'll uncover the missing third dimension.
Ibriki.
Then, we'll locate POC, the market's gravity. Third, we're going to define the 70% value area.
Fourth, we'll learn to tactically navigate walls versus vacuums.
And finally, we'll pull it all together with the architect's valuation. Let's get straight to work.
All right, Section 1, the missing third dimension. Let's transition into 3D price action.
To set the stage here, yesterday, in our Day 95 lesson, we decoded pending liquidity using heat maps that showed us what might happen in the order books. But today, we're looking squarely at the cold, hard historical reality of what actually took place.
Yeah, we're completely shifting your paradigm today. Most amateurs out there rely on traditional volume. You know, those little vertical bars stuck at the bottom of your screen? That's volume at time. It only tells you when a bunch of trading happened.
Right, but to an architect, time is kind of secondary. An architect needs to know where it happened, and that's exactly where the volume profile, the VPVR, comes into play. It takes that volume data and displays it horizontally across price levels. Instead of just knowing a big event happened at 2 p.m., you know exactly which price level holds the most historical weight. It totally exposes the underlying structure of supply and demand.
Moving right into Section 2, POC, the market's gravity.
What we're diving into now is the absolute most critical, foundational component of the volume profile blueprint, the point of control, or POC. Technically speaking, it's the single price level where the highest amount of volume was traded during a specific period. Let's unpack that a bit. In auction market theory, this POC represents fair value. It's the exact price where buyers and sellers found the most agreement. They looked at the asset, looked at the price, and collectively shook hands more times right there than anywhere else on the chart.
Think of it like walking through a massive, bustling bazaar. Sure, there might be dozens of small stalls scattered around, but there's always that one giant main shop in the center where all the heavy commerce happens. That main shop, that's your POC.
I love that analogy, and because it's the absolute center of the market's attention, price action actually acts like a magnet to it. When price action gets stretched way too far away from that main shop, a return to the POC is highly probable. The market always wants to go back to where it knows fair value exists.
Okay, Section 3, the 70% value area.
So, if the POC is the main shop, the market naturally builds a bustling neighborhood right around it. This brings us to the 70% rule, and understanding this is absolutely essential for your neurofitness.
Exactly. This rule states that the value area represents the exact price range where 70% of the total trading volume took place. It's the core of the community. This is where the vast majority of business is conducted, completely cutting out all those extreme highs and lows where only a handful of rogue, speculative trades happen.
How do we actually draw the borders of this neighborhood? Step 1 is establishing the value area high, or VAH. That's our upper boundary.
And step 2 is the value area low, or VAL, representing the lower boundary.
Now, here is the crucial takeaway. When price is inside these two boundaries, the market is in a state of balance. It's comfortable.
But the second price breaks outside this value area, whether it's pushing above the VAH or dropping below the VAL, the market is no longer in balance. It is actively out there searching for new value.
That brings us to Section 4, walls versus vacuums. Let's read the notes. Now that we've got our neighborhood boundaries dialed in, we need to analyze the granular shape of the profile itself. We're looking at the actual peaks and valleys of the volume.
Right, we visualize these shapes to give us a massive tactical edge. We have high-volume nodes, or HVNs, acting as solid walls. And on the flip side, we have low-volume nodes, or LVNs, acting as empty hallways. This visual contrast is everything. HVNs are these heavy, dense areas where a ton of traders have established long-term positions. LVNs, though, practically zero consensus exists there. They are complete vacuums.
Let's break down the tactical behavior you need to master here. High-volume nodes are those peaks sticking out horizontally on your profile. They're solid walls. Because so much historical business was done there, they act as massive, concrete zones of support and resistance. Price tends to slow down, consolidate, and literally bounce right off these walls. Low-volume nodes, on the other hand, are the valleys, the air pockets. Since there are no historical positions defending these levels, price doesn't just casually stroll through an LVN, it sprints. It gaps right through these empty hallways rapidly.
Finally, Section 5, the architect's valuation and tactical execution.
This is the most actionable phase of today's explainer. Your cognitive task today, right after you finish listening, is to open your charting software and apply the visible range volume profile, the VPVR, on a daily chart for an asset like Bitcoin or whatever your favorite stock is.
But before you do that, here is the ultimate test of your neuro fitness. If you have your POC, your value area boundaries, your walls, and your vacuums, where does the architect actually execute their trade? How does a true professional use this 3D data to position themselves?
The answer is sharp, sophisticated, and deeply tactical. At the edges of value, never, ever in no man's land. Amateurs get chopped up trying to trade right in the middle of the value area. That is just chaotic noise.
Exactly.
The architect trains their neurofitness to tune out that noise completely. They wait patiently at the edges, at the value area high or the value area low. Why? Because at the edges, you have a highly defined asymmetric bet. You are betting that the market will either reject that outside price and rotate all the way back to the POC, or it will accept the new price outside the boundary and kick off a massive runaway trend. You trade the edges and you leave no man's land to the amateurs.
Which leaves us with one final, provocative question to close out day 96. Will you master the profile to find fair value, or will you remain trapped in no man's land this cycle?
The third dimension of price is literally right in front of you. Apply the volume profile, find those edges, and truly rule the cycle.
Thank you so much for joining us for this explainer. Keep building that neuro fitness, and we'll see you in the next one.
See you next time.